Losing $40,000 in the stock market sounds like a financial nightmare, the kind of mistake most people would want to forget as quickly as possible. But sometimes the biggest losses teach lessons that success never could. Many investors enter the market thinking it's easy money, only to discover how dangerous emotions, overconfidence, risk-taking, and lack of strategy can become when real money is on the line. The painful part is that losses force you to confront mistakes, rethink how investing actually works, and develop a completely different mindset around risk and long-term wealth building. Today we will talk about I lost 40K in the stock market, and it was the best thing that happened. So before we get started, make sure to hit that like button, also subscribe to my channel. 10. Losing money in the market feels personal at first. When people first enter the stock market, they usually imagine success happening quickly. The dream is simple: invest wisely, watch the portfolio grow, and slowly build financial freedom. In the beginning, markets often feel exciting. Green numbers create confidence, small gains feel encouraging, and investing starts looking easy. But then reality arrives. Markets fall, stocks crash, portfolios drop faster than expected. And when you suddenly see tens of thousands of dollars disappear on a screen, it does not feel like a normal financial event. It feels personal. 9. Most new investors mistake a bull market for skill. One of the biggest traps in investing is that rising markets can create false confidence very quickly. During strong bull markets, many investments rise together regardless of quality. New investors begin believing they are smarter than they really are, because almost everything appears to work. Gains feel easy. Risk feels invisible. People start chasing hype, timing trades emotionally, and assuming markets will keep rewarding them forever. But eventually, every investor encounters a painful lesson. Markets do not move upward endlessly. And when conditions change, confidence built during easy money periods can collapse very quickly. 8. Losing money forces you to see risk differently. Before experiencing a major loss, most investors think about gains far more than risk. They focus on potential upside, exciting opportunities, and future profits. But large losses completely change perspective. Suddenly, preserving capital becomes just as important as growing it. A painful market loss teaches something many books cannot fully explain emotionally. Risk management matters more than excitement. Diversification, patience, position sizing, and emotional control stop sounding boring once real money disappears rapidly. 7. The market punishes emotional investing ruthlessly. One of the hardest truths about investing is that emotions often destroy returns more than markets themselves. Fear creates panic selling. Greed encourages reckless buying. FOMO pushes investors into overheated assets late. Impatience causes people to abandon long-term strategies during temporary downturns. Many investors believe they are rational until volatility exposes how emotional financial decisions really become under pressure. Losing a large amount of money often becomes the moment people finally understand that successful investing is as much psychological as it is financial. 6. Losses teach lessons success often hides. Ironically, easy success can create dangerous habits while painful losses force growth. Investors who make money too easily early on sometimes never develop discipline because they mistake luck for skill. Losses, however, expose weaknesses immediately. They reveal poor research, excessive risk-taking, emotional reactions, overconfidence, and lack of strategy. A painful loss can therefore become one of the most valuable forms of financial education because it forces investors to improve in ways success never demanded. 5. Long-term investors eventually learn that volatility is normal. One major realization experienced investors eventually reach is that volatility is not unusual. It is part of investing itself. Markets move through cycles constantly. Booms create optimism. Crashes create fear. Recoveries create opportunity. Investors who survive long enough begin understanding that downturns are not exceptions to investing, they are built into the process. Large losses feel catastrophic in the moment, but over long investing lifetimes, volatility becomes something disciplined investors learn to expect, rather than fear completely. 4. Losing money changes how you view wealth. After a major financial loss, many people begin rethinking their relationship with money entirely. Quick profits become less important than sustainable growth. Flashy gains matter less than stability. Investors start valuing patience, consistency, liquidity, and financial resilience much more deeply. The obsession with getting rich fast often fades because painful losses reveal how fragile fast success can actually be. In many cases, losing money matures investors financially far more than making money ever could. 3. The market rewards survivors more than geniuses. One of the biggest secrets in investing is that survival matters enormously. Investors do not need to predict every crash perfectly or find the next miracle stock constantly. But they do need to stay financially and emotionally stable long enough for compounding to work over decades. Huge reckless losses can permanently damage future growth potential. This is why experienced investors often focus heavily on risk management and staying in the game rather than chasing maximum short-term returns. 2. Pain often creates the discipline success never could. Many financially successful investors describe painful losses as turning points in their development. Large losses force humility. They reduce ego. They expose weaknesses honestly. Investors begin studying more carefully, controlling emotions better, diversifying intelligently, and focusing on long-term systems instead of excitement. What feels like failure initially often becomes the event that transforms someone from a gambler into a disciplined investor. 1. The best thing about losing $40K was learning lessons that could save millions later. The deeper truth about losing money in the stock market is not that losses are enjoyable. It is that painful experiences often teach financial lessons permanent success alone never would. Because the truth is simple. Markets eventually humble almost everyone. And the investors who survive long-term are usually not the ones who never lost money, but the ones who learned from losing it. And once you understand that discipline, patience, emotional control, risk management, and long-term thinking matter far more than chasing fast profits, you begin seeing why a painful loss early in an investing journey can sometimes become one of the most valuable financial experiences a person ever has. What do you think of our video? Let me know in the comment section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.